Hi everyone, it's Chris here from Serene Education. Just going to be doing the 4 majors minutes update for the coming week, which is going to be the 10th to the 15th of May 2015. Just going to be looking at the 4 majors. I'm going to start with the euro against US dollar and start with the monthly time frame and work our way down. Up until this point, you might have already done all this analysis on the monthly and worked down towards just looking at weeklies, dailies, etc. But just give you an idea, starting from the top and then working right down into those intraday time frames, looking for potential setups. So looking at what happened the prior, or looking at price action right now to see what's been happening right now in conjunction of where it's come from, that will give us an idea of where we're likely to be looking for or looking towards when we look forward. So euro against US dollar on the monthly, just looking at the hard right edge, straight away you can see a lot of indecision. We've just got rid of the second week of May. This Friday past we had non-farm payroll figures which were way positive, or a lot better than the prior month of April, in fact. So however, you can see that we still ended up with an indecision candle. But before we do any of that, let's just do our analysis. Okay, so looking at price action, price is right here on the hard right edge. You can see that we had an all-time low down here, all-time high, massive move to the upside. However, we've had a correction since. Then a major break of a long-term support and resistance level, which would have been the institution moving average, clearly here. And subsequently, we've seen a very negative start to 2015. So let's just draw a fib to start with. There we go. Perfect. Monthly fib from the all-time high to the all-time low, or all-time low to the all-time high. Your choice, entirely your choice. The fibs are going to be almost identical in terms of where you do it from the low to the high, high to the low. There's no real difference there. Having said that, straight away you can see that price action on the hard right edge. We saw the March candle closing lower than that monthly fib level here at the 38.2 at 11876 and change. However, we didn't see any continuations through the last month, in fact, which was the April month. We didn't see any continuations of the low of that candle, the body low. And subsequently, what we saw on the April close last month was almost a tweezer bottom formation. Now, a tweezer bottom indicates there's more bias to the upside, and therefore we should see a correction. So, looking into the month of May, we would then look to see if we can get any bulls coming back into the market, because you'll see that April's candle has literally engulfed. If I can just take a color here, a shape, just to show you that, take the high of that to the low of that, you can see it's actually engulfed the prior monthly candle. In this case, which was March's body high and body low candle. So bullish statement here, but this is, as I mentioned to you before, is not to do with any positive euro data. It's more to do with negative US data. In April, we had a very messy non-farm payroll result, which put more negativity on the US dollar, which would then put a little more positiveness on any cross pairs with a weak US dollar. In this case, euro, and we saw the upside bias for most of April as more and more negative news came out for the US market. So now what you can see is prices trading back above the 38.2 level here at the 11876 change. So if this is to be a genuine tweezer bottom, which is a indication of positiveness, then what we need to then look for this month is for a continuation of that positiveness. So use the 38.2 at 11876 as a support level now. Prior resistance, use it as a support. Price is trading above it right now. We have seen price trading below it or dipping lower. However, as it stands on the monthly now, you can see that indecision candle forming at the upside of that. So looking at down to the weekly time frame now, there you go, you can quite clearly see. Let's get rid of this out the way. There we go, you can see the all-time low over here. Prices failed to get below that. The tweezer bottom, which was the monthly tweezer bottom, there again, if you want to use this one over here, is almost a tweezer bottom shape. As such, you can see that price action at the close of last week still trading above the 38.2 level, but failing to break and close higher than the 20-period moving average. Now, the 20-period moving average acting as a major support and resistance level over the years. You can see the overall candlestick formations are still red, so the bias is still negative. However, we failed to see any new lows going into most of March, which would then put more bias for positiveness. And you can see quite clearly we've seen that as the MACD has grown stronger, we've seen a convergence of price and the MACD. Therefore, we're seeing a bounce or correction. Look in the indicator box, looking very indecisive intraday. The long-term bias, i.e. the monthly, is still positive in the R-squared. It's complementing that. But you look at the weekly and daily now, you're seeing a change in market sentiment in terms of a lot of positiveness intraday, on those time frames. However, the institution moving average is still above price, which is not a good sign. In this case, you can see I'm looking at the weekly. You can see the institution's way up there at the 61.8 level at 1.30300. And dropping down now to the daily, you can see that this week, in fact, we've seen price for Monday, Tuesday, Wednesday Tuesday starting below the 38.2, but then going into Wednesday's result, we saw the euro gaining a bit of momentum. However, Thursday and Friday has failed to take that momentum higher. What we have seen, however, on the daily is a change of the candlestick formation. Notice over here, you can see the candlesticks are still very much negative or red. Yes, we've had blue arrows, but we haven't seen any blue candlesticks. And this is going way back to April of 2014, in fact. So ever since we saw some over here, we saw some over here in June of 2014, but price was still trading below the institution moving average. So a pullback against the long-term trend, which was negative in this case. So here again, you can still see that the candlesticks on the far right-hand corner, you can see have changed color now. We are trading above a major support and resistance level, which would have been this consolidation level over here, which was the January low and the March resistance level highs. Now we're trading above it, above the fib level over here. As long as the 38.2 for May can act as a genuine support level, then we could very well see further euro positiveness or weak US data, and we could see a continuation to the upside unfolding. Ideally, back to the 50% fib retracement level would be a valid area if and when we did see a continuation occurring. At the moment now, you can see on the daily, we've seen a pullback against the intermediate trend, which is to the upside. Swing high, swing high, swing high. So in around this area around here, we're likely to see some sort of movement. So look to the new week's data to see if there's anything out there that could actually help euro in terms of further positiveness, or US negativity to help euro continue to the upside. We do have some data out this coming week, relating to Greece, and that's going to be vitally important. So please look at your fundamentals just to see if they give you if they do line up for further confirmation or further upside for euro positiveness, or vice versa for a potential pullback. There again, do your due diligence. As long as price stays above the 30.2 level this new coming week, then we should be looking for continuation or reattempt highs for this week. Sterling on the monthly, let's have a look over here. Clearly, you can see a lot of consolidation, a lot of iffiness on price action since the start of 2015. We did see the month of March breaking lower or continuing lower. However, looking at April, we failed to see that continuation really taking hold and pushing lower. And that was predominantly because of the negative news that came out of the US market in April. That started with non-farm payroll, the first Friday of the new month. Non-farm payroll was absolutely shocking. That had a positive effect on sterling as weakness in the US dollar continued to unfold through most of April. Here again, as you can quite clearly see now, looking at the month of May, we've seen some pullbacks to start with for the first part of the last 2 weeks. However, looking at it right now at the close of last week, in fact, you see there's more positiveness. It's trading still above the April high point, which is a good start. And candlesticks are still very much negative. Looking at the indicator box, a lot better compared to the euro against US dollar. Monthly charts still showing negativity. Red arrow, red candles, RMO below, OSMO below. The only thing we don't have over here is price making new lows. And subsequently, that's going to be painted by the OSMO or the MACD. In this case, still remaining dark red. So just looking at price action right now, we've seen a pullback. We can take the current highs that we saw in 2014 as a high, and the low here in 2015 as the low. Obviously, taking whether you draw your fib retracement from the high to the low, entirely your choice, or from low to the high, entirely your choice. But you can see that price now trading, in this case, above the 78.6 here at 1512 and change. Ideally, if this is to be a genuine correction long term, I'd like to see price trading above that 61.8. Why do you say? Well, if you look at the last couple of months, prices been hesitant. It's been stuck within this consolidated range. I'm more than happy to give this way back to the market if I'm to get a genuine correction, i.e. correction support, and then I'd like to tap into that genuine outcome. You're looking in excess of just short of 300 pips between those 2 points. Further, the higher you go, the bigger those numbers become. Here, you're just overlooking at 300 pips again, and then by the time we head up towards the institutional moving average, it's closer to the 400 mark. Not getting all of that, but more than enough. So, looking as it stands at the moment, a bias for sterling coming into the market, but that's predominantly on the back end of US negativity. Looking at the weekly time frame, you can see that the prior week's candle was one with a major wick. Okay, an exhaustion candle. For the start of the week before, we saw a lot of bias to the upside, pretty much heading into the price support and resistance level highs, which were the end of 2014 support low and the resistance level, which happened to be the 20-period moving average in February. Price is heading into that. However, by the end of that prior week, we saw the bulls clearly moving out of the picture and the bears coming back into the thing. But however, prices failed to really move on. So this over here was an exhaustion candle. So last week, in fact, we should have seen a continuation of that, and we could have potentially looked at the 145648 here as a valid target. That failed to materialize, and we didn't see any daily candles closing lower last week to concur with negativity that was coming back into the market. And subsequently, what we then would have looked at is for either sterling positive data this week or US negative data to then push or price higher or lower. In this case, finding support, and you can see sterling has rallied over the past week, last week in fact, and as we head into non-farm parallel, slight pullback on the Friday close. So as it stands at the moment now, we're quite close to that 61.8 at 155687. In fact, if you look at the close on the right-hand corner of this candle to the current fib level is 129. So there's still some profit to be made. So when we look down to the daily time frame, we can see that the institution moving average is still above price because the arrow is red, and you can clearly see that the institution moving average has hindered price moving any higher recently, i.e. the end of April, and now you can see going into the end of last week, in fact, which is the second week of May, we've seen price action yet again attempting that institution moving average. The candlesticks, having said that, are still positive, so the bias of here for sterling positiveness or bullishness is still there on the table. However, saying that, the longer she fails to break above the institution, then you're likely to see less bullish bias to the upside and more correctional bears coming back into the market. And if that's likely to occur, then we could see price reattempting the current low that she fell to recently at the start of May, back towards the 76.4, the 78.6 level, within this support level around this level here, which is the 20-period moving average, in fact. So looking at the new week, that's about to, next week, in fact, we would ideally like to see price sterling gathering pace on the outcome of last week's positiveness. Having said that, we'd ideally like to see price trading above the 61.8 to really take advantage of any genuine positive movement to the upside. Failing to see this level of year being breached, as well as the institution moving average being breached, then as I mentioned too, we'd like to see further indecisive consolidation moving back into price action, and we could potentially see price dropping back towards the 76.4 or that 78.6 level here, roughly around the 15185 and change level. US dollar Swiss franc on the monthly. Now again, huge move to the downside. Let's have a look and see how price is done. You'll notice that straight away when I draw the fib level, you can see that in and around this area right here, you can see the price action has stalled noticeably for the last 4 years. In fact, we've seen price action stalling at this major support and resistance level. It's roughly around the 98.52 and change. Major support through 2007, back again in 2009, a bit through 2010 before we saw that negativity creeping back into the market, bearish engulfing candle, and then the pullback, and then a continuation, and a very aggressive continuation lower. Then a clear move by the Swiss National Bank intervening, which caused or formed this morning star formation, and price since then has been reattempting to try and break the price support and resistance level. Unfortunately, not really doing well in doing so, and you can see going into the end of 2014, we saw the Swiss National Bank taking things into its own hands and unpicking its currency against a very weak euro, which had a major effect on price action in terms of a major drop. However, since then we've seen a correction, and price has reattempted this major support and resistance level around the 76.4 or the 78.6 level, and we haven't seen price doing anything else. If you look at the last couple of months, you'll notice that the candlesticks have failed to break the January low, and subsequently we're trading a very messy consolidative range. So when we look down to the weekly time frame, you can see that the bias is still one to the downside. If you look at the indicator box, a lot of positives coming through for the US dollar against Swiss franc. Having said that, looking at the monthly, it's starting to get very, very iffy because price has not really done much. Okay, remember, we like to trade strong trends, whether they be bullish or bearish. In this case, you can quite clearly see we're not in a very strong trend. We're actually in a consolidative range, which hasn't been prone to very good trading opportunities. And if you are trading this, the risk goes up tenfold. So you can see a lot of indecision. Ideally here, if we are to see any further US negative data, then ideally what we want to see is the institution moving average being broken. Last week's candle formed an indecision candle, a piercing candle. So if we are to see a clear further negativity, because we haven't seen any new highs recently, then ideally what we would like to see is the institution moving average being broken before we see any continuations to the downside or opportunities to the downside. Let's put it that side. So here again, you do your due diligence and look to see if the fundamentals actually give us anything of value to trade. Last pair is US dollar Japanese yen. Here again, just looking at the overall picture for this particular pair, you can see that if I take it way up to the current all-time highs to the all-time lows, you'll notice that price action has stalled at a fib level here at the 38.2 at the 120 and change level. And if you look at the reason why for that, you'll notice that going back here, you can see price action also did exactly the same thing again, or previously at 2005 through 2007. So clearly we're at a level where we're seeing a lot of profit taking, but also a lot of indecision in the market, and that predominantly has got to do with the slowdown in the US economy just recently in terms of their data. A lot of negative data, especially non-farm payroll wasn't great in April. This one was far better. However, saying that, we've seen some uncertainty on the markets. The longer we fail to see the US dollar making new highs, the more certainty is that we're likely to see further bears coming into the market, which would then see a further, more prolonged drop to the downside. And we could be looking in excess or back towards that 50 period moving, a 50% retracement level here at the the double Nelson level at 111.57.3. Okay, so looking at the weekly now, see a lot of resistance. Candlesticks are still positive. A lot of resistance over the past couple months, in fact. So need to see a bull candle breakout. Okay, and once we get that weekly candle breaking higher, then what we can do then is look towards any daily candles preceding that on the new coming week, breaking above the prior weekly support or resistance level, for us then to look for an entry and then target towards that 23.6 level at the 130. Between the current resistance level highs that we see in the end of 2014 and the start of March, you're looking just under 1,000 pips. So there's a lot of profit to be made if and when the US dollar actually gives a signal. The longer she fails to make a new high, the more uncertainty comes into the market. The less trading you're likely to see, the more indecisive candles you will probably end up looking at, and we could see further bears coming in to push price lower. So here again, look to the fundamentals to see if there's anything out there that could actually help this particular pair in terms of direction. Otherwise, give the entire week back before we get a genuine confirmation, because if we fail to see new highs, then we could be looking or look for the 20 period moving average to be breached in terms of a weekly candle close lower, because that would in turn open up further opportunities to the selling, counter trend opportunities, and we could be looking back towards the 50% level, which is back towards the 50 period moving average down here at 111573 and change. So here again, guys, please do your diligence. There's a lot of data out this week, a lot of important data for Europe in particular, and there's also a lot of data for the US market coming out each particular day. So just make sure that those major points, there's something out there that could actually help price actually move higher or lower, and wait for the candlesticks to give us a genuine confirmation candle before we actually trade. Have a fantastic week ahead, and most importantly, trade serenely.